For our Did You Know segment today, this is going to be the first of a three-parter. I'm excited about this. We're going to talk about home equity mortgages. And there's two particular ways that you can tap into your home equity. What we're going to do is today we're going to talk about home equity mortgages. These are what we call closed-end mortgages, meaning you will make fully amortizing fixed-rate mortgage payments, and at the end of your term, your mortgage is paid off. So that's why it's called closed-end. We're going to talk about that today. Next week, we're going to talk about home equity lines of credit. And then week 3, we're going to do a comparison. We're going to do a side-by-side, and hopefully this will help you to determine which route may be best for you if you are particularly interested in tapping into your home equity. So the definition of a home equity loan, it allows borrowers, homeowners, to tap into the equity that they've gained in their home through home improvements or market appreciation, more so the latter in the current environment. This provides you with a lump sum of money at closing with a fixed rate, and there are some programs available that have adjustable rates, but by and large, people elect for the fixed rate for a stable monthly payment, and then you get the money in a lump sum. Your mortgage is a second mortgage. I'll get into that in a moment, and that is for a fixed term and rate, meaning that you can have a 5-year all the way out to 30 years on this. So you can amortize that loan and pay that back from anywhere from 5 to 30 years. So the key features are, number one, most are fixed rate, the wide majority. Secondly, this allows you to tap into your home equity up to around 80 to 85%. I can speak to what we offer. We also have some investors that we work with that will go up to 95% of your home's current value. Albeit, the higher up you go in accessing your home equity, the higher your interest rate, because that increases the risk. The borrowing limit is also dependent on your qualification. So we do conventional approaches to qualification, looking at debt to income, credit scores, and of course, your equity. There are some tax benefits to this as well. When you're tapping into your home equity to do home improvements, you have some write-off with the interest, the mortgage interest on your property, and you don't have to deplete your cash to do it. You're taking the money out of the asset that is going to get improved. So you have a bit of a compounding benefit that's occurring there. How does this work if you have a first mortgage? I'm glad you asked. Let's think about it this way. If you have a first mortgage on your home, and then we're just going to use easy numbers. Let's just say you have $500,000 mortgage. That's your current balance. It goes based on current balance. And you want $200,000. And let's just say your home's $1 million right now. Okay? Well, you have a $500,000 first mortgage. That mortgage is going to stay. We're not going to touch that. If you have a mortgage, particularly prior to 2023, it's very likely your mortgage rate is below 4%. You don't want to touch that. So we're not touching that mortgage. That mortgage stays the same with the same rate, same term. We don't touch that. This home equity mortgage becomes a second lien. So you got first lien, second lien. The second lien gets put on your property for the mortgage amount that you're applying for the home equity mortgage. That, let's just say, is $200,000. So now total, you owe $500,000 for your first mortgage, $200,000 for your second. If your home is $1 million, 500 plus 200 is $700,000. That's the total leverage on your property, which is 70% of your current home value. That mortgage gets placed as a lien on your property. After you close, you get the money in your account, and then you go into repayment just like your first mortgage, and now you will have two mortgages. You'll have your first mortgage and your second mortgage. We look at the equity of your property. Just from that little example, you saw how the numbers work and how we need to leverage that. If you go above 80%, the interest rate for this financing takes a hit. It starts to go up quite a bit. If you stay and keep your leverage, total leverage on your property at 80%, even at 85%, your interest rate's going to be reasonable. You can use this money. Most commonly, I see this used for home improvements, debt consolidation, education expenses. Let's say you've got children going off to college. You don't want to take out student loans for all of it. Maybe you tap into some of your home equity. And then large purchases or emergencies that may arise. So with all of that in consideration, let's take a look at what the current trends are in the market. Home equity loan rates right now, I would say, are averaging around 7.9 to 8% for the most part. I happen to be assisting a client right now with one of these, and they elected for a 20-year term. And so I can tell you, in the market space, they got 7.49%. So that is something that is just an experience that I wanted to share to show that averages, particularly for second mortgages, it takes into account a wide variety. Home equity lines of credit, I'm going to talk about next week. They have a little bit more, and there's different implications for that. That's why I wanted to split this up. This is also gaining a lot of popularity right now. Home equity mortgages to consolidate debt. Let's consider the fact that we're at, let's just say 7.9% as an average that I found through my research for second mortgages in the marketplace right now. Well, your credit card debt, whatever your balances are, you're sitting with double-digit interest rates at minimum, upwards of 20% in most cases. Even though that's been showing a little bit of relief with interest rates coming down slightly, some credit cards up to 29%. So that's a wide range. It's important to take a look at those credit card bills. It may make sense to consolidate that debt and get a home equity loan, because here's the really bonkers statistic. Currently, U.S. homeowners hold over $29 trillion in home equity in total. So if you take into account everybody who owns a home right now, the overall assessment is around $29 trillion. That's a ton of equity. If you have high interest rate debt on credit cards or car loans, things like that, you can leverage a home equity mortgage to take out money, pay that off. Obviously, it may mean adjusting your spending. We talked a few episodes ago about the gap that has occurred when we look back from pre-pandemic. Almost 20% price increases on everything, and wage growth was only 8%. So there's a wage deficit, I'll call it. There's a wage deficit of nearly 12%, and that translates to the U.S. consumer by way of credit card debt, because then the balances just creep up. This could be a way of fixing that and helping you to make your expenses more manageable. The pros are you have a fixed rate and fixed payment. You can manage your budget a little bit better maybe than the adjusting interest rates on your credit cards and the high interest rates that you're paying on those. And then you could have more large capacity for borrowing, so you could take out more money. So these are the pros. The cons are there is a risk of foreclosure if there is a compression in real estate values. As we talked about earlier, it's highly unlikely right now, but that is still a risk worth mentioning. Also, it's an added monthly payment. I always like to make part of the process comparing what you're currently outlaying to what this would yield for you. So bear that in mind. And then potential closing costs. Some of these loans could carry with them higher loan costs.